The makeup of U.S. health insurers' investment portfolios have undergone a sea change over the last decade, according to a new AM Best report. Here to speak with us on these trends are Jennifer Asamoah, AM Best financial analyst, and Jason Hopper, Associate Director of AM Best Industry Research and Analytics. So Jennifer, can we start with you? The report notes that the industry's invested assets have grown at a fairly sizable clip over the last decade. What's driving that growth?
Well, as you noted, we've seen that the health industry have seen a sizable growth in invested asset, averaging 8% annually, with a shift to non-traditional asset classes. So the challenging low-interest environment have compelled many carriers to consider this non-traditional asset classes as a means to boost their overall investment income. Also noted in the report is that the trend, or the growth trend that we've seen, is driven by national players as Kaiser, which accounted for 22% of the segment asset in 2017. The top 5 carriers, however, accounted for 44% of the asset, and the top 10 accounted for 56% of the invested asset, which included larger publicly traded organizations and also Blue Cross Blue Shield companies as well.
So also growing are holdings in medium to high risk assets. Does that concern AM Best?
Well, overall, AM Best have a negative view on the rising allocation to higher risk invested asset. The growing exposure to riskier asset kind of create potential for losses for the industry and also places additional pressure on the capital for the industry. However, for most of the carriers, we've also noted that they have sufficient risk-adjusted capital and also overall liquidity to mitigate this concern. We also noted that since 2014, capital has increased 24%, and that kind of also decreases the exposure to capital over the last 3 years. We also noted in the report as well that most carriers, as part of their ERM process, do an extensive stress testing over their invested portfolio, which builds in additional cushion for capital and liquidity levels. Despite all of this, AM Best will continue to monitor the industry's allocation to riskier asset and see what the impact will be on their balance sheet and overall risk management.
So Jason, what other portfolio shifts is AM Best seeing?
We have seen a number of portfolio shifts, much of which have been within the confines of the bond portfolio itself, which still makes up the majority of investments at health insurers, somewhere between 50 and 60%. So within the bond portfolio, we have seen a number of changes, one of which is somewhat of a deterioration in credit quality. We've seen an uptick in NEIC2 bond investments. This has been relatively widespread throughout the industry, so it's not just some of the larger players driving this trend. We've also seen health insurers kind of tweaking their bond portfolio maturities around the margins, specifically shorter than 1 year, so cash or short term, and those investments longer than 10 years. So that bucket between 1 and 10-year maturities has actually increased from 50% of their bond portfolio to roughly 70% in 2017 nowadays. Private placements have also seen an uptick, so that's another trend that we've seen. However, this is driven mostly by the larger publicly traded companies and some Blue Cross Blue Shield companies, while some of the smaller companies have made more marginal investments within private placements. We do note that the large shift to private placements have come in the form of 144A, which do offer more liquidity benefits than typical private placements, being they can be sold on a secondary market. But again, that has been mostly driven by the larger publicly traded companies and Blue Cross Blue Shield. The last most noteworthy, I think we would mention, would be the uptick in BA investment assets. This has been more largely driven by the larger publicly traded companies and to a lesser extent Blue Cross Blue Shield companies as well. The closer ear paid attention to vertical integration and continued innovation has led to health insurers forming more joint ventures and other partnerships with other companies, leading to that greater investments within scheduled BA.
So have those allocation movements translated into improved investment income?
To an extent, I would say that overall net yields have increased over the last 2 years for health insurers. At the same time, they've ranged between 2 and 3% over the last 5 years, so that uptick hasn't been that noticeable. In general, overall gross investment income per asset has been relatively consistent. And from a broader perspective, investment income as a whole has been relatively around 1/4 of total net operating gains over the last 10 years. So any growth in investment income has kind of moved within tandem with overall operating performance as well. So that is something that we would note. Kind of just reiterating what Jennifer had said before, health insurers have been creating more sophisticated investment models, have been paying a little more attention to their overall balance sheet risk framework in terms of stress testing certain asset classes, BA, private placements, things like that. The uptick in high-risk assets has been somewhat of a concern because that could lead to potential losses with the combination of private placements and lower credit quality and BAs we've already been discussing. But the health insurance industry in general does have more than adequate risk-adjusted capitalization. We haven't seen that much of a deterioration in liquidity. So from that perspective, health insurers are still within our comfort zone, but it's something we'll continue to monitor.
Jason and Jennifer, thank you for speaking with us today.
Thank you.
To see the full report, visit ambest.com. For AM Best TV, I'm Meg Green.